Thank you, Paul, and welcome back to Zurich. I'm very pleased to host today's panel to talk with experts in the emerging manager space. Dialing in from London, UK, and welcome our panelists, all of them interacting with emerging managers on a regular basis and, of course, accumulated lots of experience over the years. Therefore, I'm very pleased to introduce Jan Faber from Bregal Private Equity Partners, Gabriel Bogossian from Stevenson Harwood, and Wilf Wilkinson from Acanthus. And I suggest to hand over the virtual mic to our panelists to quickly introduce themselves, starting with Jan.
Thanks, Ralph. Morning, everybody. So my name is Jan Faber. So I manage the fund investment business for Bregal on behalf, we manage capital on behalf of a European family endowment. We have around 3 billion euro of capital under management from this endowment. We focus US and Europe, roughly 50-50, very focused on the small end of the market. And we have been backing first time and emerging manager on a active and selective basis for now many, many years. We also have a bit of experience with starting with partners, often on a fundless sponsor basis, doing deal by deal as a precursor for then later on doing launching the first fund. So we have quite a number of examples of that in our history.
Thank you. Moving on to Gabriel.
Thanks, Ralph. Gabriel Bogossian here from Stevenson Harwood. I'm a private equity lawyer. My practice focuses on helping institutional investors with their primaries, secondaries, and co-investment programs. And I've been working alongside Unigestion and advising them since 2009, actually, on quite a number of these emerging markets investments, manager investments, and secondaries, as well as co-investments.
And finally, Wilf.
Thanks, Ralph. Wilf Wilkinson, managing partner of Acanthus. We're a specialist placement agent focused on advising high quality specialist European private equity managers. And you know, we over the last 2 decades, we've supported numerous first-time teams, and that remains a core focus of what we do and what we enjoy.
Great. So I think it's great to have you all here. I think it was important for us to get perspective from different angles, placement agents from the lawyer side and also from the LP side. I guess I would like to start the panel with kind of the most fundamental question, essentially, what is the value of an emerging manager in a private equity portfolio? And as an LP who is very active in investing in the segment, what is your perspective, Jan?
Yeah, just highlighting two things, Ralph. So first and foremost, of course, the reason why we are investing these first-time funds, right, is because we need to believe that there's an opportunity to generate premium returns over and above what the larger and more established funds tend to generate. So that is, of course, the main driver. But also, we also found it very interesting to start actually investing in the life cycle of a GP early on, because also if they work out, you really have the opportunity to invest with the GPs for many funds generation and build up a long relationship, and also build up a meaningful relationship. Often you start with smaller with the first fund, because the first fund is a bit smaller often. But then over time, you can actually build up quite a sizable exposure with these firms. And there's a number of examples in our portfolio where we are now in the 4th or the 5th generation after having started from the beginning. So these are the main reasons. And then you can ask yourself, what drives these premium returns, right? And there's a couple of things maybe to highlight also. I think first, again, also we like the fact that when you're in these first-time managers, the motivation and the energy is often at its max, right? So and that's a key driver, I think, for us, why we like to get involved from the beginning, because that first fund needs to work, it's do or die, and with all the energy behind it, it's often a good ingredient for why to succeed. Of course, the strategies needs to make sense, and often the strategies are a little bit more specialized in nature. We just did something again, which was more like a roll-up of insurance brokers in the US, very, very specific, but specialized strategy we tend to see more. of course, the people. It's all about getting the comfort and the conviction with often one or two individuals, right? And then there's a bit of category. You have sometimes very experienced people who have done it all over again, which you can easily kind of check out and look at track record. But we also found that actually sometimes it can be also very attractive to get involved when the people are a bit more the up and coming talents in the previous firms, and it's maybe a little less proven, but you have to take a bit more of a judgment call then on the people. But they also can work out really well, and then we have some examples of people in their mid to late 30s which actually get started sometimes on a fundless sponsor basis, which then grow into a first-time fund when they eventually then raise the fund. So there's different journeys and different journeys which can succeed.
Interesting. Wilf, maybe question for you. Of course, LPs expect some sort of outsized returns when investing with emerging managers, but I guess when you are advising emerging managers and then helping them selling to LPs, what are non-return related reasons in your view why LPs could be interested in this segment?
Yeah, I mean, Jan's touched on a few of them, but I think Jan referred to specialization, and I think often when a manager, well, when someone decides to start a new private equity firm, there needs to be a reason for that private equity firm to exist. And that is often because it provides exposure to a particular niche or a particular sector or a particular strategy that is, that exists in larger, more generalist managers, but is sort of diluted within a generalist pool. And so, what we look for when we are assessing whether or not to take on a new emerging manager client is, whether they bring something different in terms of exposure, whether that's sectorial or strategic, usually sectorial, and that ties into the fact that, often, emerging managers are focused on the smaller end of the market. So often more intransparent, more complex cases, and that usually requires operational expertise to be within the core team. So not just a group of investors or financiers, but usually a mix of investment, but also operational experience, and that usually means someone that has worked for many years within a particular sector and built up true sectoral expertise. I think also one of the big advantages of backing a fund number one is that there's no legacy, and 100% of that team's focus and efforts, at least until they raise the second fund, is focused on delivering an absolutely outstanding return. And so you get usually not only a ton of focus and time on ensuring success, but also you get a more attractive cash flow profile because the fund is deployed quicker. And as the fund is, and therefore LP's money is put to work and put to return generation, in a quicker timeline, and therefore, the economic profile of the fund vehicle is more efficient and more attractive. And ideally, you get a tighter gross to net spread on your returns. And finally, I'd say, with a new group that's eager to get into business, related to the alignment point, I think you also will often find, an LPA that is LP friendly, and that's a very reasonably balanced partnership between LPs and GPs.
That's a good point, Wilf. I think that a couple of the themes that Jan and yourself have mentioned play out in the legal documents. So we've talked about concentration, whether in terms of investment policy and focus, sector focus, and also concentration in terms of people capital, human capital. Tends to be a couple of founding partners, maybe 3 at the most, which we see, but very often a single founding partner. Clearly, I'll let the commercial folks talk about the outsized returns that has the potential to deliver, but from a legal perspective, we're looking to counter that and hedge the risks which come with these essentially startup platforms to give some protection to the investors or the first-time backers who take that plunge. And what's interesting and exciting for me as a lawyer is that rather than taking a off-the-shelf LPA, which is a recut version of the Fund 5, 4, and 3 LPAs, we're sitting down in a kind of partnership model, as you've said, and with the aspiring GP, and we draft up a term sheet which really sets out how we see the relationship playing out. That being said, in return for our backing and capital and institutional guidance, these are the protections which we will need. And I shy away from terms like LP friendly or GP friendly because truly the protections we put in there are in many cases never referred to, but are just the safety measures that I need to put in place so that they're available to us. I can give a couple of examples. So what I would call enhanced protections, which are necessary here. Clearly, given the concentrated team, key man or key person is an obvious place to start. Whilst the traditional fund model would describe that as substantially all of your business time being spent on this fund product, that's very vague and broad. So we would tighten that up considerably and make sure that it's not other products, sidecars, continuation vehicles, it's only this fund. Clearly, and it's not just a time commitment, there would also be an aspect of being a bad lever, which is that concept taken from equity documents. So aspects of behavior which don't represent the institutional investors' investment ethos would be included as triggers for a key man event. And that leads to removal. As you will often know, for cause removal is an incredibly high threshold in most LPAs. You generally have to take the manager to court and prove to a criminal standard, for example, beyond all reasonable doubt, that they've been fraudulent, and it has to be a non-appealable judgment. The reality is that there are no assets left by that stage. In the LPAs which we put together with Unigestion, I've seen concepts such as step-in rights. If this gets to an adversarial court position, whilst it's being decided, the fund will be put into suspense, and the largest investor will have the ability to step in and manage or appoint a replacement manager. Clearly, if the original manager has done no wrong, they'll be indemnified, replaced, and their management fee will be made whole. But that's an example of a step-in right, which I don't think you could ever expect to see, or perhaps even need with a large platform, but is a necessary protection which we put in place. And now I know the fund too is doing spectacularly well. So it wasn't necessarily required. And then finally, Wilf, you mentioned the focus on a single vehicle. And so the trigger for raising a successor fund is slightly higher and also clearer. In the larger platform funds, we often see that the GP can single-handedly decide when they've reserved in their discretion 75% of the total commitments for future investment or even for fund expenses, they can go and start marketing their future vehicle, which we all know takes a huge amount of time and focus. In the fund products which we're drafting and putting together, we want to see that money's actually been invested and put into the ground, into assets, rather than just reserved or set aside or entering into legally binding contracts. That's not the trigger. The trigger is you've invested the vast majority of our money, following which you can go and we'll probably back you if the returns are good.
Maybe touching quickly a bit on a couple of Europe-specific topics. I think, Will, your job is essentially to successfully place the emerging managers within the European and also US LP base. And it seems like that, particularly in Europe, there is still a large supply-demand imbalance when it comes to allocate capital to the segment. And I would say, despite being a highly attractive marketplace, why do you think there is still not more dedicated capital available for European emerging managers?
I think, there are a few kind of barriers to being able to participate in the emerging manager space. Clearly, aside from the fact that obviously the complexity of performing due diligence on new teams. I think one of the barriers for large allocators to access emerging managers is simply size. Any of the most capital for private equity globally sits within what I would term mega allocators, so the large public pension funds, the very, very large endowments, sovereign wealth funds, etc. And most of those simply cannot invest in managers that are smaller than $1 billion. And even $1 billion is at the low end for someone like a CalPERS, for example. What that means is that the first-time funds are generally for specialist smaller groups of LPs. I think the US market is perhaps slightly different because usually a first-time fund in Europe will be a sector specialist within a specific region of Europe. The US has an advantage of being an enormous market, an enormous single market, and therefore you see the entry point for first-time managers being that much larger, and so they do have access to those larger allocators that can put to work, a minimum of $50 to $100 million in a fund without being the sole LP. The last 2 years has certainly shown me is that there is no replacement for an in-person meeting when you are backing someone for the first time. You have to meet that person, you have to build trust. There are other ways in which you can build that trust, obviously through maybe there is a lot of visibility within the portfolio that somehow mitigates the absence of being able to spend lots of time with the group. But I think COVID has, there's a lot in, a lot of dialogue in the market about, private equity booming through COVID. If you look at it, the vast majority of that is a rapid acceleration of existing managers coming back to market and raising repeat funds. Actually, emerging manager volumes have broadly stayed flat or shrunk over the last couple of years.
Mm-hmm. Jan, do you see any differences when investing capital in the US versus Europe?
Just to prove Will's point, we just did the first-time fund. It's basically it's a guy in the US which raised 800 million just off the cuff, right? So that's kind of that you see in the US. You have seen a few examples over the last decade in Europe, but very few, right? So true. So there's a bit more. The opportunities tend to be a bit bigger there, but I think it's also the mindset of the LPs that they're probably a little bit more appetite for backing these opportunities. And in particular, look, the US university endowments, which actually is quite a big chunk of the capital, they are very open-minded for the situations. And they're also very sophisticated in making these assessments. And what in Europe, firms like Unigestion and other specialized firms are doing, I think in the US, you have these bigger endowments are able to get a mind around and then sometimes can play also with much larger amounts when these funds get raised. So it's absolutely true. It's also a much more active market, right? So we see it in our business that it's on continuous, right? You're being approached for very credible partners who have left their firm, setting up their business, and so it is a different. I think Europe's still a bit behind, but it's also the opportunity, I think. So the fact that these first-time funds are also a bit smaller in Europe is often also makes it a bit more interesting often as entry points. And so I think the opportunity from an investor point of view, Europe is great, but US is more developed, right? That's for sure.
Yeah. Maybe a question for Wilf. Obviously, as a placement agent, you often act as an advisor to the GPs to raise successfully. What would be kind of unappealing aspects of an emerging manager offering, or what are you typically focusing on when you invest them?
I mean, the obvious thing is, Jan has touched on a couple of these, but we would prefer to raise a fund that is based around a single individual than 2 or 3 individuals who haven't worked together before. So we have successfully raised first-time funds where there is a single key individual with a very clear strategy, very clear track record, clear expertise. It's a much greater challenge when you have even 2 or 3 individuals who come together and haven't worked before. So I think a mistake that we sometimes see is people hiring too quickly just in order to try and present a broader team. Actually, to get going, what you need is a clear strategy, a strong pipeline, and focus. You don't necessarily need bodies on a page to persuade people that you're a credible team. So I think there's that. I think related to a credible fund size is also a credible portfolio strategy. I think a misconception is that a first-time fund needs to have that that perfect diversification. Actually, the reason why an investor backs a first-time team is in order to gain exposure to alpha, and over concentration is generally dilutive to that. And so especially if you have a relatively new, relatively small probably team with a strategy that will often be relatively time consuming, high touch, operationally focused. If you go out and say, well, look, we're going to be doing 10 investments of broadly 20 million of equity each, and therefore we want to be raising 200 million, we would far rather say, actually, look, you should really be thinking of 6 maximum investments and be thinking about 100 million, 120 possibly, if you have things that exceed massively the size. If you have opportunities that are outsized for that fund size, make sure that you have LP partners on board that can support you in co-invest, and you can plug the gap that way. And so we're wary for first-time funds that are too ambitious in the number of deals that they want to fill up in a first-time fund. We have a massive preference for rather concentrated first-time vehicles rather than large over diversified ones.
Yeah, great.
Terms and conditions, maybe. Often LPs like investing with emerging managers because they can achieve better economic terms, lower total expense ratios, and one tool is obviously co-investments. But I think co-investments are not always just about economics. Wilf, how would you assess kind of the value to offer co-investments to prospective LPs beyond the economic benefit?
Of course. So, co-investments are a thorny issue. A lot of GPs hate it and see it as a way of LPs freeloading There is nothing that will get you closer to your LPs in terms of giving them an insight into how you work, giving them, a look under the hood of what actually makes you special, what actually differentiates you. So, economics aside, it can be a very, very valuable way of forging an incredibly strong relationship and a lot of trust, a lot of mutual dependency with your LPs, ultimately your clients.
Going back to what I mentioned earlier, it's not an off-the-shelf document, so we can query some of the standard metrics, like why is every private equity fund out there 10+2? I say most. They don't need to be, and particularly where it's a smaller pool of capital. We have seen shorter fund lives, 7+2 being one we saw recently. That's mutually beneficial, clearly. The investor can get their money back more quickly. The first-time manager has a track record. They're then able to move on to the next fund because, as you pointed out, Will, the economics sometimes require them to go on and create a new vehicle, having one established themselves with that track record. So, when we're talking about the T's and C's, it's a wide open. It's as open as a football field. So, fund life can be different. Distribution waterfall, the standard 20/8 that you can open the vast majority of PE fund documents, and that's what it will say, isn't necessarily the case here. We have seen quite a few staggered or tiered carry waterfalls, progressively increasing the carry from 10, 15 to 20. We have also seen hurdles which aren't just based on a preferred return of IRR. It can also include a money multiple.
Great. So unfortunately, time is already up, and I'm sure we would still be sitting here in an hour to discuss the topic if we had the chance. I do appreciate that you made yourself available for the event. I thought it was very interesting, and I encourage the viewers to submit any questions which arises from the discussion, which then can be addressed in the Q&A session at the end of the event. And with that, I hand back to Paul.